Have you ever wondered how economic indicators influence trading decisions? Well, let's dive in. Economic indicators are statistical data points that provide insight into the overall health of an economy. They are like the vital signs of the financial world, offering a glimpse into the economic conditions and trends that shape our lives and the markets. Traders pay close attention to these indicators as they can signal potential shifts in market conditions. Throughout this video, we'll be focusing on 5 major indicators: gross domestic product or GDP, employment rates, inflation, interest rates, and consumer confidence. Each of these indicators plays a unique role in the financial markets, influencing everything from the value of currencies to the performance of market sectors. Understanding these indicators can equip you with the knowledge to make better trading decisions. So, are you ready to dive in? First up, we have the gross domestic product, commonly known as GDP. It's a measure of the total value of all goods and services produced by a country within a specific time period. It paints a picture of a country's economic productivity and size. Think of it like this: when GDP is on the rise, it's like a sign that the economy is strong. Businesses are likely thriving, consumers are spending, and the financial market is buzzing. This can create favorable conditions for trading, especially in sectors that are driving the GDP increase. On the other hand, when GDP is shrinking, it's a hint that the economy may be in a slump. This could mean that businesses are struggling, consumers are tightening their belts, and the market may be more volatile. In such situations, traders might need to adjust their strategies, perhaps focusing on defensive stocks or safe haven assets. In essence, GDP provides a snapshot of a country's economic health and can influence trading strategies. Next on the list is employment rates. The employment rate tells us the percentage of the workforce that's currently employed. This is a crucial economic indicator, as it gives us a snapshot of the labor market's health. When employment rates are high, it means more people are earning wages and are likely to spend more, stimulating economic growth. Conversely, low employment rates often signal economic slowdown, as fewer people have disposable income to spend. This can have a significant impact on trading. For instance, higher employment rates can boost consumer-oriented sectors such as retail, leading to a positive sentiment in the stock market. On the other hand, a sudden drop in employment rates might trigger a sell-off in these sectors, causing market volatility. Therefore, traders often closely monitor employment data, using it as a tool to predict market trends and make informed trading decisions. So, employment rates can act as a barometer of economic health, influencing market sentiment and trading. Now let's talk about inflation. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising. It's like a slow but steady tide that erodes the value of money over time. When inflation is low, your dollar today will be worth roughly the same tomorrow. But when inflation is high, the value of your dollar shrinks, and it buys less and less. So, how does inflation influence trading? Well, a rise in inflation can lead to a decrease in the value of a country's currency. This is because as inflation increases, purchasing power decreases, and more currency is needed to purchase the same amount of goods and services. Inflation also affects interest rates. Central banks often respond to high inflation by increasing interest rates, which can lead to lower consumer spending and slower economic growth. These changes can impact various market sectors and influence trading strategies. Therefore, understanding inflation dynamics can be crucial in making informed trading decisions. Another key indicator is interest rates. These are the cost of borrowing or the return on savings set by a country's central bank. When interest rates are high, it's more expensive for businesses and consumers to borrow money. This can slow economic growth, as people tend to save more and spend less. Conversely, lower interest rates make borrowing cheaper, which can stimulate economic activity as people are more likely to borrow and spend. Now, let's delve into how this impacts trading. Higher interest rates can make a country's currency more attractive to foreign investors, leading to an increase in its value. This can affect currency traders who buy and sell currencies based on these fluctuations. On the other hand, stock traders might see a decline in stock prices due to decreased corporate profits from higher borrowing costs. Interest rates, thus, play a pivotal role in shaping trading strategies. Last but not least, we have consumer confidence. This particular economic indicator is a bit different from the ones we've discussed so far. It's less about hard numbers and more about sentiment, the degree of optimism or pessimism that consumers feel about the overall state of the economy. When consumer confidence is high, people are more willing to spend money because they believe their financial future is secure. This increased spending can stimulate economic growth, leading to bullish market conditions that can be advantageous for traders. On the flip side, if consumer confidence is low, people tend to save more and spend less, which can slow economic growth and lead to bearish market conditions. Traders need to keep a close eye on shifts in consumer confidence, as these can signal potential market trends and influence trading strategies. So, whether you're a bull or a bear, remember this: consumer confidence indeed has a significant influence on market trends and trading. Now that we've covered the major economic indicators, let's recap. We began by defining what economic indicators are. These are statistical measures that provide insight into the overall health of an economy. They are significant in the financial markets as they give traders a glimpse into economic conditions, helping them make informed decisions. We dove into the gross domestic product, or GDP, which measures the total value of goods and services produced in a country. We learned that a rising GDP often signals a strong economy and can boost market sentiment, while a falling GDP can indicate economic slowdown and dampen market enthusiasm. Next, we explored employment rates. High employment rates often signal robust economic growth, potentially leading to an uptick in stock prices. Conversely, high unemployment rates can indicate economic struggles, potentially causing a downturn in the markets. Then, we turned our attention to inflation. This economic indicator measures the rate at which the general level of prices for goods and services is rising. Moderate inflation can signal a healthy economy, potentially driving markets up. However, high inflation can erode purchasing power and potentially dampen market sentiment. We also discussed interest rates. Higher interest rates can attract foreign investors looking for better returns, which can strengthen a country's currency. Conversely, lower interest rates can discourage foreign investment, potentially weakening a country's currency. Lastly, we delved into consumer confidence. A high consumer confidence index suggests that people are feeling optimistic about their financial future. This optimism often translates into increased consumer spending, which can stimulate economic growth and boost market sentiment. In conclusion, understanding these economic indicators is crucial for making informed trading decisions. They can signal potential market trends and provide insight into the overall health of an economy. Remember, knowledge is power, especially when it comes to trading. Understanding economic indicators can give you the edge you need to succeed in the markets. Thank you for watching, and happy trading.